The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, trying to make sense of this market trade at midweek in front of a February World Agricultural Supply and Demand Estimates report that's going to give the trade some more fodder here to end up the week. Let's talk about what we're seeing in the markets. Joining us for a conversation, Kent Beadle with Paradigm Futures. Kent, good to catch up with you again. Thanks for joining us today. And I'm sure, like many folks east of the Rockies, enjoyed some unseasonably warm temperatures in your neck of the woods, Kent, right?
Yeah, Jesse, my grass is turning green. May have to put the snowblower away and get the lawnmower out. It's unbelievable for February here in Minnesota. It's very surprising.
Yeah, very, very surprising. And it's not that typical winter weather, of course, that, shuts down grain movement and things like that. But even then, I don't know how much grain's moving right now because this market's just looking pretty rough, Kent. I mean, I've used this analogy quite a few times the last week or so, that it feels like a lot of the weight has gone to the bearish side of the boat in grains and oil seeds. Your thoughts on that?
Yeah, there's little doubt about that. If you measure this any way you wish to, there's 3 different CFTC reports that you can look at. And you can take the corn position, for example, which has never been this short except for 2019 in the trade war and 2020 post-COVID. You can take soybeans, meal, and oil and combine them and find out that we've never been this short with the exception of the 2019 trade war. You can add in corn, beans, meal, oil, and all of the wheats and find out we've never been this short other than in the 2019 trade war as well. So, look, there's a very significant bet being made toward lower grain prices that are a function of a couple of things. Certainly we don't have balance sheets that are rationing balance sheets like we've had the last couple of years. We've needed to be high enough to actually slow demand down. Instead, what we're trying to do is find that price point where we're actually ramping demand up. We're actually succeeding in the corn market to some extent. Average trade guess for tomorrow's report is for a little bit smaller ending stock because we're ahead of the pace that we need to be on with corn exports. And our ethanol grind has been good if you take out those couple of weeks when the nat gas rationing situation during the cold snap forced a number of ethanol plants to slow down. So, we're at a price that's been buying some demand. Even our soybeans, relative to the USDA's estimate, if you add up current existing sales plus the shipments, we are just barely underneath the average percentage marketed or sold as of this date through the marketing year. And so I don't think we're doing a bad job. It's just, we have a very major bet being made by the speculator. There is another piece to this, of course, and that is Chinese demand and this idea that somehow China is, they're somehow going to export deflation to the rest of the world. Let's be fair. They are a major consumer of commodities, and they have been through their entire economic growth spurt. If we were worried about, or we were in the business of merchandising lumber or steel or cement or all of these other things that they have grossly overbuilt and clearly are going to have to contract on going forward, you would be a little bit more worried. But we're still talking about 1.3 to 1.4 billion people. And by the way, we're talking about 1.3 to 1.4 billion people with a GDP growth of north of 5%, which is disappointing to many, But if GDP growth is growing 5% with that type of population, do you really think that demand for food is going up or going down? I'm not convinced that it's necessarily going down. I'm not convinced that an economic contraction in China, and let's face it, we already had one with COVID, is going to necessarily mean less demand from the Chinese consumer for pork or for chicken or for soybean oil to fry different things. But that's the bet that is being made by the large speculator. And as long as it keeps working, as long as that aggressiveness is able to drive prices lower and the trend continues to move lower, they're going to keep piling in here. At some point, the number of bullets they have will, be greatly diminished, and the amount of grain demanded by the end user, not just here in the U.S. but around the world, will start to exceed the amount that the fund is willing to sell. And we get to that point, and things will start to look a little better. And obviously, we've had a couple of false starts with that narrative already. We've had we had a key reversal higher last week and some high range closes before we traded poorly Friday, and then so far this week. There have been a couple of other times it looked like maybe we were turning the corner, and we just haven't done it yet.
Yeah, we just have not done it yet. Soybeans were the biggest loser on Wednesday. I saw this headline out Wednesday from the Rosario Exchange that they're anticipating Argentine production down 20 to 30%, but largely it felt like the trade just looked at that, traded it for, 30 minutes, and then shook it off. And I know that a lot more folks put more weight into CONAB and, of course, USDA, which we'll get those updates on Thursday. But soybeans in general, outside of that nugget, just felt like the path of least resistance there was to the downside on Wednesday, Kent.
Well, think about this. The private estimates out of Brazil, you have a very low end estimate at down around 135 million tons. But the high end estimates have been right around 150. And yet the average trade estimate for tomorrow's report is 152.5. What does that tell you? It tells you the trade does not believe that the USDA is going to be aggressive at all in getting down to the area that the marketplace is pretty certain that the crop is at. And this, to be fair, if you think about where CONAB's number was last year, their official number, right? Well, the USDA is about 5 million tons higher than that for last year's crop. And they're 5 million tons higher than Argentina for last year's crop. It's almost 10 million tons of supply that was on the carry-in balance sheet for this year's World S&D that neither Argentina nor Brazil said that they have, but the USDA believes that, or has kept those supplies in the balance sheet. So I can't tell you why this exists, why this is going on this way, but that's what we're seeing is a real reluctance for the USDA to lower estimates to where the trade actually believes the crop is really at.
Yeah, it's quite interesting. It's almost like they slow walk it, if anything, with the USDA numbers that we've been getting here in recent years, Kent.
Yeah, no, and look, I don't know that it's political. I don't know if there's there's some effort to try to keep a lid on food inflation here. It is an election year. Those are the kind of things that come to your mind when you wonder why they're doing some of the things that they're doing. But we have to live with what they give us.
We are talking today with Kent Beadle from Paradigm Futures here on Market Talk. Kent, I'd love your thoughts on the wheat markets too, real quick. Yeah. All three classes were a little bit higher, led by Chicago SRW on Wednesday. Right. If I'm looking at charts right, though, it looked like that maybe that carry in spring wheat has gone away in the front month. I'm not sure But
Yep.
your assessment of this wheat trade overall here right now, Kent?
Well, a couple of things. We've fallen to an area that has done two things. It's pretty well shut off movement from the country. Hence the spreads, starting to tighten up. And if you look at measures of average U.S. basis levels across all three wheat classes, they have been trending higher. From the day that the marketplace rolled from bidding off the Dees futures to the March futures, we've been moving higher. I think we recaptured all of that carry and probably plus a little bit now as we're moving into, the last few weeks before the new delivery month. So that's basis levels getting better, spreads getting tighter. You have Kansas City trading at an inverse, and Minneapolis now having moved to an inverse today as well. This is a market that is trying to incent some bushels into the pipeline in order for millers to be able to have enough supply to make some flour. It's certainly not coming from any huge export program, because we all know that that's not what we're doing. We've got some outstanding sales on the books yet to China, and we've been not all that quickly getting those shipped. We'll do a little bit, in a week, and then we'll go a few weeks and we won't ship any of that outstanding sale. But I think it's domestic demand at this price is needing to buy wheat more than the American farmer is willing to sell it.
Kent, something we were talking about as well before we went on the air that I'd love for you to give a brief explanation, if you can, to some folks. I know a lot of people have heard the term Goldman roll, but some folks who are maybe watching, listening in, maybe they don't understand what exactly that is. And you indicated to me that maybe we started to see some of that here on Wednesday. Can you just explain what the Goldman roll is for us quick?
Yeah, and I think we actually have seen it sort of a pre-hedge for that roll, or a positioning ahead of that roll, maybe yesterday and even Friday and Monday. What that is the Goldman Sachs Commodity Index is one of 3 or 4 major commodity indexes that get what we call passive investment. And in other words, dollars that come from pension funds or from long-term investors who want to have diversified exposure with a portion of their portfolio away from equities and away from bonds and into something that is, backed by some sort of hard asset, like commodities. So the Goldman Sachs Commodity Index is made up of a number of different commodities, probably a little more weighted toward energy, but with a component that's weighted into corn, into soybeans, into Chicago wheat, into cattle and hogs. And they take their front month futures position, and between the 5th and the 9th day of the month prior to the delivery, they take and they sell the long futures that they have in that position, and they roll them ahead to the following position. And that bear spread activity has a tendency to put a little extra pressure on front month futures. Yesterday, for example, we saw, corn was down 4.5 cents, but new crop corn was only down 0.5 cent. That was the kind of sort of pre-Goldman roll activity that we get used to seeing sometimes. And I think that there was maybe a little bit more of that going on today. Of course, we were close enough to contract lows with yesterday's activity that we get a little more of that price action today. And the next thing you know, we're into new contract lows in the March corn. And that triggers a certain amount of additional selling, either from longs who decide to throw in the towel, or maybe even some new shorts who want to add to their position, who like selling contract lows because it tells them that their position is working and they should add to it.
Love the explanation. Thank you for that. I think some folks find that helpful. And I think it's something too that, things like that, things like the Goldman roll can add into, with, like we were talking, funds and managed money. I mean, it could all add together to the volatility in this market environment that we have today, right?
Yeah, absolutely. We've got more things coming at us, to be honest with you. Certainly we have the crop report tomorrow, and everyone's talking about that. But something that I would touch on today is that we're going to get the USDA Outlook Forum starting a week from today. Excuse me, a week from tomorrow, a week from that following Thursday. And I'm certain that the speculator is looking ahead to that and is probably excited about the fact that the USDA is going to give us a corn yield number that will more than likely be 6 bushels an acre higher than the record yield that we had this past year because of their regression trend line and the fact that they started in 1988, which was a drought year, which was a very low yield year, which kind of tips things a little bit higher, tips the slope of that curve higher. They're going to tell us that this year's trend line is probably going to be 183 and a half bushels an acre, even though we've never produced better than 177.3. And you're going to put that into next year's balance sheet, and you're going to show a growth in the carryout. And that's, of course, these are bushels that haven't even been planted yet, let alone grown and harvested, and the yield is a long ways from being certain. But for a little while, we might decide we want to trade that. I remember very well in 2020, the last time we did this, where the USDA in between February and May started printing 3 billion bushel carryouts for the following year, and I think we ended up at about 1.4. It wore everybody down, and I think that's the other piece between Chinese economic concerns, and then there's next year's crop, and I think those are the two linchpins to this short position that the funds are currently carrying.
Great thoughts on the grains, livestock, cattle and hogs. Kind of a mixed bag on Wednesday, though, Kent, this cattle market feels like there is a lot more optimism coming back into this cattle trade here as of late. Would you agree with that?
Oh, for sure. Look, there's this expectation, and there has been an expectation that these high prices and reasonable margins for the cattlemen are going to ultimately result in a growing of the herd. We're going to retain heifers. We're going to build our calf herd, and we're going to start to grow the cattle inventory again. And of course, last week, the inventory report from the USDA threw a bunch of cold water on that. Not only was inventories a little bit lower than trade expectations, but the number of lightweight calves, recent number of calves into the marketplace was just quite a bit lower, and it indicated that there just has not been any actual expansion activity take place as of yet. And so we are likely, going to go through another year with less cattle this year than we had last. And obviously last year was a pretty good year. So, there has to be some reason for optimism. We're starting the year out at a higher level than we started last year out. And we have to keep in mind that corn prices are quite a bit lower. So there may be some reasons that cattle prices won't get as high this year as they got last year. But that doesn't mean that profitability might not be just as good.
Kent, always appreciate a conversation. Final thoughts from you real quick. Anything you want to reiterate to folks today?
Oh, I think that growers should have a little bit of patience at these lower price levels. Understand what costs of production are, right? Be ready to make some sales at obviously levels that aren't nearly as profitable as the early sales that were made last year. But I wouldn't necessarily give up on the market having some sort of a seasonal rally, because the other years when we have been short like this, we have had rallies where that short has been erased and longs have been put into place with similar fundamental stocks to use situations. So I may have to have some patience. You may have to use some tools in the toolbox, like making some sales and some reownership and options, or what have you. But hang with it. It's still likely to be okay at some point in time here this year.
Ken, if folks want to reach out to you and get some advice and talk markets with you there at Paradigm Futures, how can they reach you, Ken?
My number is at 651-491-2119. We can also be seen at www.paradigmfutures.net.
Appreciate the time as always with that. Kent Beadle from Paradigm Futures. Thanks for joining us on Market Talk, and we will look forward to talking to you again real soon.
Thanks, Jesse. Appreciate it.
That's going to do it for the show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.